Hello everyone! In this video I'm going to talk about psychology of investing and the main traps into which investors, beginners in particular, can fall. Mistakes. Everybody makes mistakes. The reasons for that can be poor analysis which doesn't allow to glimpse companies' problems, or too high and unreasonable risk taken, or too positive and unrealistic estimation of experts' abilities. Now I'm going to highlight the main principles of the psychology of investment. So, the first and I think the most important principle is striking a balance. The investor's attitude to his investment is built on two emotional states. On one hand, it is greed and desire to earn more. On the other hand, it is a fear of loss and hesitance in taking decisions. And the problem is to find the right balance between these two emotional states. Investors are considered to be more sensitive to loss than to risk and possible return. In short, people prefer not to lose $100 rather than to earn $100. Some estimates suggest that people perceive losses more than twice as painfully as potential gains. And as a consequence of this fear, investors are reluctant to realize the scope of loss and therefore hold their stocks for too long, expecting a recovery in the future. This is obviously a wrong approach. The right thing to do is to re-evaluate the stock you have and to make a serious analysis of possible gains and risks. If there are other stocks with a better risk-benefits relation, then sell your stock and buy the other one. Don't marry your stocks. Another important principle is information accessibility. Taking decisions in the investment market is often based on diverse and unreliable information. Therefore, many people often are in search of the source of relevant information about price fluctuations, and they have to work with a huge flow of information. Consequently, some investors become too addicted to the constant monitoring and amount of information, which in turn can decrease income because of too much hesitance and because it's easy to get lost in the woods of information. And hence, it blurs your own point of view. Another side of the coin is when people don't ground their decisions on analytical information, but follow a herd. It is important also not to adopt decisions imposed by your environment and avoid giving into the hype. On the basis of the majority's opinion, the illusion of conviction is being formed. An example of this is when people started to buy Tesla shares after they reached their peak. Thereafter, stocks went down. In this case, it is important to start thinking slowly and take decisions based only on analytical calculations. Another trap is not to build high expectations. Over-reliance on what you really think can often lead to wrong decisions. For example, if one thinks that the company is successful, which is based on one's own subjective perceptions, it is likely that the person will invest in companies according to personal loyalties. This preconception may be totally incorrect. You have to make a very serious study of the real situation of the company and not think that it is successful just because of a superficial impression. Therefore, in order to avoid this trap, you need to use flexible thinking, deep analysis, and be open-minded to perceive new sources of information while understanding the reality, which is that any company can be here today and gone tomorrow, no matter how successful it seems today. Another principle to consider is being too much prudent and dreading investment. Even though sometimes this fear can be absolutely justified, especially at the beginning when you need more time to adjust, it can be the consequence of a lack of knowledge about a more balanced investment portfolio, in which there can be stocks with low and stable returns, and at the same time with moderate risks. So, it is important always to be ready for a risk to a reasonable extent and diversify your risks. One more problem, which has something in common with the previous one, is a tendency for people to irrationally continue to follow through on an activity or investment that is not worth continuing. This is due to the time and money people have already invested. So again, don't marry your stocks. Just because you dedicated so much time to studying a company, it is not a valid reason to continue to own shares in that company. So it is important here to have a realistic view and the ability to recognize that the wrong decision has been made and avoid waiting too much for recovery. If you invest only in one company or only in one sector, you risk losing everything when prices fall. The benefits of a diversified portfolio are that even if company goes bankrupt, This might lead only to 10% loss in your whole portfolio, while the other assets in your portfolio can compensate and exceed the losses produced by the failed company. Another trap is believing that the past equals the future. It is the so-called irrational exuberance trap or the recency bias. In this case, investors are acting as if there is no uncertainty in the market. Unfortunately, uncertainty never disappears. There will be always highs and lows, bubbles, overheated stocks, panic selling, and so on. The fact that you succeeded in something doesn't mean that this tendency will keep, so you should be always flexible, rational, and not rely too much on previous success. Don't confuse the bull market with brains. Some people think that they are geniuses just because they were lucky in catching a bull market wave, but this will not continue forever. So, that's all for today, guys. Hope you liked this video and see you in the next one.